They say money is power, but what if the real power lies in the hands of institutions most people never see, never vote for, and never question? What if the system you trust to protect your savings was intentionally engineered to quietly siphon value from you, drop by drop, year after year, without you ever noticing? Because tonight's story isn't about simple economics or interest rates, it's about the hidden architecture of control that sits beneath every paycheck, loan, price tag, and political promise. This is the story of how central banks control your wealth. Exposed. Welcome to Dollaroid. To understand the scale of the system we're about to unravel, we need to go back, long before modern nations. Before digital money, before inflation charts and press conferences. Centuries ago, when kings ran out of gold to fund wars, they turned to early bankers for loans. But those loans came with interest, and interest came with influence. That ancient dependency, rulers needing money created from nothing, would evolve into a global system where governments depend entirely on central banks, and central banks depend on citizens never asking the wrong questions. The first major piece of this puzzle forms in 1694 with the creation of the Bank of England. Britain was drowning in war debt and needed fast cash. Private financiers stepped in, offering to fund the government, but only if they were granted the authority to issue the nation's currency. A private group of elites gained the legal right to print money, lend it to the government, and charge interest on it. It was the birth of the national debt, and the birth of a model so profitable it would spread worldwide. Cause and effect: the more governments borrowed, the more central banks gained power. The more central banks gained power, the more governments relied on borrowing. This dependency became the backbone of the modern financial world. Fast forward to the early 20th century. The United States, now an emerging global superpower, faced repeated banking panics. People lost trust in commercial banks, loans froze. The economy collapsed into chaos again and again. But behind the scenes, the wealthiest bankers saw an opportunity, a central bank of their own. In 1910, a secret meeting took place on Jekyll Island, an isolated private club off the coast of Georgia. The men attending represented 1/4 of the world's total wealth, and the plan they drafted would reshape global finance forever. In 1913, the Federal Reserve was born. Its mission was sold as stability, but its actual power was something far greater. It controlled the supply of money, the cost of borrowing, and the financial heartbeat of the largest economy on Earth. From this point forward, the story shifts dramatically, because once a central bank controls money, it controls everything built on top of money: wages, housing prices, debt loads, government spending, economic booms, recessions, and even the rise and fall of global empires. And the true turning point, the moment money stopped being money, arrives in 1971. For decades, global currencies were tied to gold. You couldn't print unlimited dollars because every dollar had to be backed by something real. But as wars grew expensive and government spending exploded, the United States faced a choice: reduce spending or break the link between dollars and gold. President Richard Nixon chose the second option, ending the gold standard. Overnight, money stopped being a tangible resource and became a promise backed by nothing but trust. And the policies of central banks. This was the breaking point. Once money became fiat currency, central banks were free to create as much of it as they wanted, and every new dollar reduced the value of the dollars already in your pocket. Inflation wasn't an accident anymore. It became a built-in feature of the system. Cause and effect: more money creation leads to higher debt. More debt leads to more interest payments. More interest payments lead to more dependence on central banks. And while inflation quietly erodes the savings of ordinary people, asset prices, stocks, real estate, corporate holdings rise, enriching those closest to the money supply first. This pattern has played out over and over. The 1980s debt explosion, the 2000 dot-com bubble, the 2008 financial crisis, and the massive money printing of 2020 and 2021. Each time the system cracks, central banks respond the same way: lower interest rates, print money, expand their balance sheets. They rescue the economy, but that rescue always comes with a cost. The cost is future inflation, future debt, and future dependence. And the groups benefiting at every stage are always the same: large financial institutions, governments, and those with access to capital. Meanwhile, the fallout always lands on the same group: the everyday saver, the middle-class worker, the retiree watching their purchasing power melt away over time. Now let's connect this story to today, because the modern data is not just shocking. It's mathematically unsustainable. In the past 40 years, central banks have printed more money than in all previous centuries combined. Since 2008, the Federal Reserve alone created trillions of dollars out of thin air, pushing its balance sheet to levels considered impossible just a decade earlier. Central bank balance sheets in Japan and Europe have also ballooned to historic heights. The consequence? Every dollar today buys less than it did yesterday. The average home price in the U.S. rose over 500% since 1980. Global debt surpassed $300 trillion, growing faster than global GDP. The system now depends on constant money creation to avoid collapse. If central banks stop printing, the economy crashes. If they keep printing, inflation surges. Either direction, the average person loses. And here's the pattern no one talks about. Every major economic crisis of the last century was either caused, worsened, or fixed by the decisions of central banks. And each crisis concentrated more financial power into fewer hands. It's a loop. Crisis gives central bank intervention, gives temporary relief, gives more dependency, gives larger crisis, gives stronger central bank power. And each loop tightens control. Even failed fixes are part of the pattern. Interest rate cuts that were supposed to stabilize markets instead triggered asset bubbles. Money printing that was supposed to be temporary became permanent policy. Bailouts that were supposed to prevent future crises incentivized even riskier behavior. And now, we're re-entering a new phase: central bank digital currencies, digital money issued directly by central banks. With CBDCs, the institution that already controls the money supply would gain control over transactions, spending behavior, taxation, and savings at a level never seen in human history. It's the next step in the same story, the same cause and effect, only with more precision and less transparency. So what does all of this mean for you? Let's end with 3 clear takeaways. First, inflation is not a natural disaster, it is a policy decision. The system requires inflation to function, and the value lost from your savings becomes value gained somewhere else. Second, debt is the true currency of the modern world. Central banks create money by creating debt, and your economic reality is shaped by how much debt governments and corporations choose to accumulate. Third, the system is designed to reward those who understand it and punish those who don't. Wealth flows toward assets, not savings. Toward those closest to money creation, not those holding on to shrinking dollars. And here is the final warning: the next major shift: digital currencies. Rising debt, geopolitical instability will expose the fragility of a system built on promises instead of value. The more you understand how the system works, the less power it has over you. If you found this breakdown eye-opening and you want more stories that reveal the hidden forces behind money, wealth, and global power, make sure to subscribe, share this video, and stay tuned. Because on Dollaroid, we expose the financial world the way nobody else will.